You've got $100 and someone has finally convinced you it's time to start investing. So you look it up, and every single video shows you the same chart, the one where a small amount quietly turns into a fortune over 40 years. That chart isn't lying to you, but it is answering a question you never actually asked. Picture a seed, plant it in a pot on a windowsill. It'll sprout. It'll look promising for a few months, and then it will stop. Not because the seed failed, but because the pot decided how big it was ever allowed to get. Plant that exact same seed in open ground, and there is no ceiling on it at all. Same seed, same water, completely different outcome. Your first $100 is the seed, and almost nobody on the internet wants to talk about the pot. So let's run the math that never makes it onto the screen. $100 invested at 10% a year. That's a genuinely good return. Better than the long run average delivers in most years. Your gain in year one, $10. $10. That is less than an hour of work at minimum wage, and it is your entire first year as an investor. Fine, you say, it compounds, so leave it completely alone for 40 years and let it work. After 4 decades at 10%, your $100 becomes about 4,500. That number is real. It is also not a retirement. It's a used car, 40 years from now. And in today's money, once inflation has had 4 decades to chew on it, it's worth closer to $1,400. So where did that other chart come from? The one that ends in half a million? That chart was never showing $100. It was showing $100 a month. Same 10%. Same 40 years. $100 once becomes 4,500. $100 every single month becomes about 530,000, which means the money you started with accounts for less than 1% of that final number. Less than 1%. 99% of it came from one thing, and it wasn't the seed. He kept showing up. Now, here's the comparison that really ends the argument. Say you invest $100 at 22 and never add another cent. By 65, you've got about $6,000. Now, say you do nothing at all until you're 32. You start a full decade late, but you put in $100 a month, every month, from then on. By 65, that late starter has about $266,000. Starting 10 years late with a system beats starting a decade early without one, by more than 40 to 1. Everything you've been told about starting early is true. It's just nowhere near as important as what you do every month afterwards. And here's the part that should sting slightly. Remember that forgotten subscription? The $13 a month draining quietly in the background? Canceling that one subscription puts $156 back in your account every year, starting immediately. Your first year of investment returns was $10. One canceled subscription beat your entire portfolio by more than 15 to 1, and it beat it on day one instead of in 4 decades. That is not an argument against investing. It's an argument about what you're actually optimizing while you're still standing at the bottom. So if the returns are that irrelevant, why bother at all? Why not just wait until you've got real money? Because your $100 was never buying returns. It was buying the machinery. Think about everything that has to exist before a single dollar can compound for you. An account has to be open. Your identity has to be verified. A transfer has to be connected and actually working. You have to know which button moves money and which button does something you didn't intend. None of that is investing. All of it is plumbing. And every bit of it has to be built before the compounding everyone talks about can even begin. Your $100 is what you pay to build that plumbing while the stakes are still effectively zero. And then there's the part nobody warns you about. At some point, fairly soon, your money is going to go down. Not because you did anything wrong. Because that is simply what markets do. On a schedule nobody gets to know in advance. The first time you watch your own money shrink, something happens that has nothing to do with math. Your stomach drops. You feel slightly stupid, and a very calm, very reasonable voice suggests you get out now, before it gets worse. That voice is the single most expensive thing in personal finance. It is the reason ordinary people reliably earn less than the exact funds they own. They buy after the good news and sell after the bad. So here is the real value of starting with $100. A 20% drop costs you $20. $20 to learn, in your body rather than in theory, what a falling market actually feels like, and that you lived through it without doing anything. Learn that identical lesson at $50,000 and the tuition is $10,000. You are not buying growth. You're buying the cheapest possible version of an education you will need eventually anyway. There's a second thing happening too, quieter than the first. The second contribution is easier than the first. The 10th one you barely notice. The habit compounds long before the money does. And that brings us back to the pot and the ground. The pot was never the amount you put in. The pot is whether any of this machinery exists at all. $100 sitting in a real account with a working automatic transfer behind it has no ceiling on it whatsoever. $1,000 sitting in your head as a plan you'll get around to has a ceiling of exactly zero. So where should that first $100 actually go? Because the honest answer is that it might not belong in the market at all yet. There is an order to this, and getting it wrong is how people end up technically invested and practically stuck. First question, do you owe money at a high interest rate? If you're carrying credit card debt at 22%, then paying off $100 of it saves you $22 a year. Guaranteed. Permanently. Starting now. Compare that to investing the same 100 for an expected $10, which is not guaranteed, and which in plenty of years will be negative. $22 certain beats $10 uncertain. That is not a close call, and no investment on earth is offering you a guaranteed 22%. Paying down expensive debt is investing. It just doesn't come with a chart, so nobody makes videos about it. Second question, if your car broke down next week, what actually happens? If the answer is that you'd have to sell whatever you just invested, then you haven't built an investment. You've built a delayed emergency fund with extra paperwork and much worse timing. Because markets fall hardest at exactly the moments people lose jobs and hours get cut. The point at which you're most likely to need that money is the point at which it's worth the least. A small cash buffer first isn't being timid. It's the thing that stops you being forced to sell at the bottom. Third, and only once those two are handled. Automate a contribution, not a lump. Broad, low-cost, diversified funds, held inside whatever tax-advantaged account your country makes available to you. Paying less tax on the same return is the one genuinely free improvement available to everybody. And set the transfer to run by itself. On the day the money arrives, before you get a chance to have an opinion about it. Run that on Carl from the last video. He freed up about $370 a month by closing his background drain. He has no credit card debt, but he also has nothing set aside, so his first $200 goes to the buffer, not the market. Then $100 a month automatic on payday, which puts him on the $530,000 line rather than the $4,501. Same person, same income, different order. Now the honest caveat, and this one genuinely reorders everything above it. If your employer matches retirement contributions, take that first. Ahead of the debt, ahead of the buffer, at least up to the match. A 50% match is an instant 50% return on day one. Nothing in any market beats that, and it is the only place in personal finance where free money is genuinely sitting on a table waiting. And one more. All of this assumes reasonably steady income. If yours moves around a lot, the buffer comes first, and it should be bigger than you think. So 6 months from now, here's what this actually looks like. Your balance is not impressive, it's a few $100s. It went down twice along the way, and both times you did nothing, which felt harder than it sounds. That's the whole thing. That is what you were building the entire time. The account exists. The transfer runs without you. And you already know what a bad month feels like, back when a bad month cost you $20 instead of $10,000. The seed was never the variable. It never was. The pot was. And you spend $100 finding that out at the only point in your life when finding it out is genuinely cheap. So if this changed how you think about that first 100, the next video is about the buffer we just talked about and why $500 protects you better than $5,000. Subscribe and it's already waiting for you.